As one of the best fund managers of all time, many investors look up to Peter Lynch for advice on stock market investing. And for decades, he has given invaluable insights and wisdom about the stock market and how they work. He is also no stranger to market crashes, as he experienced several market crashes as a fund manager, especially the Black Monday when the Dow fell 23% on a single day. So in this video, we're going to analyze how Peter Lynch survived and even generated a good amount of return during market crashes. And we're going to describe the techniques he used to do so. Also, I will give you a bonus video of Peter Lynch talking about his experience managing his fund during the 1987 market crash. What fascinates me with Peter Lynch is his simple principles when investing. Every rule I described below is very simple and can be applied by anyone. It's also still very relevant today, especially with the amount of speculation going on in the market right now. Let's get to rule number 1. Focus on company fundamentals, not on macroeconomic developments. When investing, it is important to realize that there are many variables that we can control, and macroeconomic development is one of them. We can't control when and how the stock market is going to crash, and the chances of predicting them are pretty low. Some do profit from predicting macroeconomics, such as Michael Burry, but how many investors out there who are able to successfully predicting stock market crashes with precision? The answer is almost none. So, the real focus of an investor should be in picking great companies, as in the long run, the markets do go back up, and stocks with great fundamentals will go up. And if you already analyze the company fundamentals of a great company, a stock market crash becomes an opportunity to buy a great business at a low price. Number 2. A stock market crash will eventually come. There's no doubt that the US stock market or any stock market will eventually crash. We cannot know when and how the stock market is going to crash, but it will crash. This is because of the business cycle effect, and there's no way of stopping it. The economy has behaved this way for centuries, and will continue to do so in the future. Peter Lynch often said that it is fruitless to worry about stock market crashes, as it is a part of our economy. What matters is in picking great companies and stick through it, as history showed us that investors can earn good returns even when the markets are crashing. Number 3. Think long term. Warren Buffett once says that time is the friend of a wonderful business, and Peter Lynch fully agrees with this statement. Both Warren Buffett and Peter Lynch have talked extensively about the importance of thinking about the long term. In order to win at investing, it is important to focus more on the long-term performance of a business rather than daily market fluctuations. Number 4, and probably the most important rule: know what you own. Peter Lynch said that lots of people are more careful about buying a fridge than buying a stock. They compare the price, the size, and they look at the customer reviews before buying. But when it comes to buying a stock, most people just look at the news headline or as a friend for stock recommendations. Buying a stock that you don't understand is a recipe for disaster, especially in a bear market. That is gambling, not investing. So, before you buy a stock, try to understand the business behind it. This is why I stick to investing in businesses that I can understand. If a stock market crash occurs, then I can still sleep well at night if I know what I have bought.
October has always been a special month. I remember in 1987, I was very, I was very convinced that the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we were going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day. which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. And I said to Carolyn, you know, I think if the market goes down on Monday, you know, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention, you know, in two working days. You know, I said, at the end of this week, I'd be have no fund. Now, there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open, you know, by 12 o'clock, it was, in Ireland, it was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, well, what's Lynch doing? They said, well, he's on the 6th hole, and he's, you know, he's even par up to now, but he's in a trap. This could be, you know, this could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. As though I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and you know, because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. As long as the times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year.